Hello everybody, welcome to Clef Investments. In today's video and several future videos, let's talk about covered call, which is a very popular strategy and why I think in most cases it's not a good strategy. So 3 years ago, actually, I spent 4 videos discussed why we shouldn't do covered call. And I feel this topic is important enough so that we can discuss this in more details. So what is covered call? Covered call is an option trading strategy where in your portfolio you own stocks and then you sell out of money calls regularly on top of the stocks at a strike above the stocks. Looks like the calls have covered the stocks, and that's why it's called covered call. It's also called buy right because you're writing calls on the stock you bought. And you sell the out of money calls regularly, very often monthly. And when the call expires, it either expires worthlessly, so you make a profit, or you need to buy the call back. So it depends on the stock price when the call expires. It may go up or down. And if the call expires, you have extra money to buy extra stocks for the next month. Or if you have to spend money to buy the call back, you would have to sell some stocks to get the cash so that you can close the call. But to make it simple, let's assume you buy and sell stocks to always keep the cash balance be zero when the call expires. The basic properties of the call looks like the picture on the right. It has limited upside potential and unlimited downside potential. So the picture on the right is the profit or loss part. The x-axis from the left to right is the stock price, and the y-axis is your profit and loss. And there's a zero in the middle. So you can see that when the stock price is above a break-even point, this strategy starts making money, but up to a certain point, because the profit is limited by the calls sold. If the stock price goes down, the strategy will lose money similar to stock, and there's no downside limit. It can keep losing money until the stock reaches zero. So it has unlimited downside risk, but only limited upside potential. So to look more detailed about a basic covered call strategy, for every 100 shares of stock, you would want to sell one call. And if the previous call expires, then you have made money on the call. So you can use extra cash to buy more stocks. Basically, your portfolio increases. Or if the previous call becomes in the money because the stock price goes up and it crosses the strike price, then you would need to sell some stocks and get cash to buy back the calls, maybe at a loss. And how to choose the strike of the call? Somebody use a percentage like 5% higher than the current stock price. But that may not be a good way. A better way would be to choose the strike depends on the implied volatility of the stock. Because some stocks like Nvidia are very volatile. So you want the strike to be very far away from the stock price. While some stocks have much lower implied volatility, such as SPY, the S&P 500 index. In that case, the call strike can be much closer to the stock price. And a common rule of thumb is peak based on the probability of the call becoming in the money. If your brokerage doesn't give you this value, then you can use delta as a replacement. So if the probability of ITM is 50%, then the delta would be 0.5. And commonly, the at the money call or put has a delta of 0.5, and the probability of ITM would also be around 50%. If you look at the table on the right, I picked today's stock option price, and I picked the option expiring date that's closest to 1 month, which is 33 days. So I chose a high volatile stock, Nvidia, and a medium stock, Apple, and a not very volatile stock, SPY, S&P 500. So you can see that their implied volatility range from 44% down to 24%. And the higher the implied volatility, the more volatile the stock price is. Then I picked a call strike that has a probability of ITM of around 27% for all three stocks. And then for that call strike, if you check how far out of money compared to the stock price, for NVIDIA is almost 7%, for Apple is 5%, but for the very unvolatile SPY, it's only 2.6%. So you can see that because of the very different implied volatility, even when they have the same probability to be in the money, their strike distance can be very different. And also, if you divide the price of the call to the price of the stock, you can see that for NVIDIA, the call is very expensive. It's 2.87% of the stock price. And for SPY, it's only 1.27%, less than half. And Apple is between them. So although they have the same kind of probability to be in the money, the price of the call is very different compared to the stock price. If you time this by 11, you get the annual price. Why 11, not 12? Because this is 33 days, slightly longer than a month. And in 1 year, there are about 11 of 33 days. So if you keep selling calls and each call expire worthlessly, then just by selling calls, for NVIDIA, you would make 32% in 1 year. Or in Apple, you make 17%. In SPY, you make 14%. So all these numbers are huge. So this is one reason that people like covered call. But remember, the probability to be in the money is about 27%. So that means in those 1 year, you may have 3 to 4 times that the stock would go up too much and your call would be in the money and you lose money on the call. So that has to be taken account of. Okay, so there are many issues of covered call. And the main issue is its basic property. Whenever you see a trading strategy which has limited upside potential and unlimited downside risk, you should evaluate very, very carefully because this is a very big red sign. And the first small problem is that it's not tax efficient because when the call expires every month, if it makes money, it would generate a short-term capital gain tax, which can be 54.1% in California. And that means even if you make a lot of money on the call, you lose more than half to the government. And it's also possible that you make money and pay tax for several years. And then later you get one big loss, but you already paid tax. You cannot get the tax back to cover this loss. You have to carry over the loss for future years, which is very painful. It can hurt your portfolio dramatically. So this is a big problem, but it's easy to understand. And even if you don't need to care about the tax problem, for example, you are doing covered call in your Roth IRA, there are still more and bigger problems for the covered call that we will discuss in future videos. Okay, finally, a disclaimer for this video and all other videos in this channel. I was just sharing my personal views here, not investment advice. Investing involves risk, so please do your own research and make your own decisions. Thank you for watching and see you next time.